Good morning, everyone. I'd love to introduce you to Eliza Owen from CoreLogic for today. Take it away.
Great. Thank you so much. Thanks everyone for joining us. I'll just pull up my screen. So today I'm going to be providing a housing market update that looks at capital growth trends. We'll look at sales and listings activity, as well as a little bit on the rental market and implications for rent yields. You may notice from our new slide deck here that CoreLogic is now Cotality. So Cotality is this rebrand that we've been through, which is kind of a global refresh for what has become a very global business. Our parent companies in the US have been acquiring lots of different products and services over the past few years. And so we're really bringing that together under this new brand. So we are Cotality, which our tagline is Intelligence Beyond Bounds. And the new name is meant to reflect the collaboration across borders, totality of data, and vitality across the organization. Obviously, it's a bit funny to be saying the new name. I know a lot of people are still attached to CoreLogic. Some people are even still attached to the RP data name. So it might take a little bit of getting used to, but hopefully this time next year, we've all got Cotality on the brain. So I wanted to start just with a very high-level overview of where we're at for Australia's housing market as of the end of June. Cotality valued the entire stock of residential real estate at $11.5 trillion. And against that, we've got about $2.4 trillion of outstanding debt. The number of dwellings stands at 11.3 million, and the amount of turnover is about 5.1%. So we've got about 530,000 sales over the past 12 months, put at a gross value of over $500 billion. And I think these stats really just put into perspective how large Australia's housing market is. You can see it's bigger than the combined value of other major assets like superannuation, the ASX, and commercial real estate. And it also makes up a big component of household wealth as well at about 56%. Now, I thought it might be good to start this presentation before I go straight into housing market performance, just to touch base on where we are with interest rates. Despite holding in July, there is a lot of data to point to the RBA reducing the cash rate in August, as we're definitely seeing signs of lower inflation, even a little bit of loosening in the labour market, though it's still pretty tight. And this could lead to the RBA bringing the cash rate down in August, as well as maybe another 1 or 2 times this year. So if we look at forecasts for interest rates at the moment, I've got the actual cash rate over time, and then that blue line is looking at, it's meant to be different forecasts for the 4 major banks, but because they've all kind of got the same forecast for the trajectory at the cash rate at the moment, it's just that single coloured line. So at this stage, each of the major banks, as of the July decision to hold the cash rate, are expecting 1 more 25 basis point reduction in August and then another rate reduction in November. If we look at where the cash rate is now, we can see that it's sitting relatively high compared to the historic decade average pre-COVID, which was an average interest rate of 2.6%. And it's pretty much on par with the 2-decade average prior to COVID, which was about 3.9%. But by the end of the year, we could expect the cash rate to come down to 3.35%, and then markets are currently forecasting that the cash rate could get to a little above 3.1% by the March quarter of next year. And by the way, that's pretty much where the RBA currently places the forecast for the cash rate as well, assuming that all their other forecasts are met in terms of reduced inflation, unemployment, and economic growth for the Australian economy. So the big takeaway here is that even though the cash rate was held in July, most forecasters and indications of future cash rate expectations are for it to continue to move lower in 2025 and possibly lower again in the start of 2026. As it is, so far, banks have been pretty proactive about passing on those rate cuts. So remember, we've seen a reduction in both February and May, bringing the cash rate down 60 basis points so far. Across average mortgage rates of different product types and between outstanding and new loans, we've seen an average reduction in mortgage rates of about 43 basis points. So based on the averages, the cuts haven't been fully passed on, but the majority of it has been passed on through to mortgage rates. We've actually seen a little more of that pass through in outstanding rates, which means existing customers, if you like. And that could be because people are probably very keen to refinance. And so by ensuring those cash rate reductions are passed through to existing mortgage rates, the banks can help to retain customers. So in terms of the increase in mortgage rates that we've just been through, it seems that households have coped pretty well. We did see a bit of an increase in mortgage arrears over the past few years, but nothing like a blowout that we would have seen during the GFC, particularly in the US. And overall, Australia's arrears rates in terms of late mortgage repayments have stayed relatively low over time. So some of the way that households have been able to cope with higher interest rates and higher mortgage payments are by reducing their savings buffers. And we've seen this with the national accounts data over time. This is the savings rate for households. You can see it peaked during COVID, where people weren't really going out anywhere, and we had a real boost to incomes and obviously a massive reduction in interest rates. So during that time, people really built up their savings buffers. As interest rates rose and inflation plagued households, that led to this drawdown on savings rates. And that's how people potentially service more of their housing costs as well. The good news now is we can see that savings rate starting to move higher. So that suggests that households are looking in a bit better shape financially. We've also got the multiple job holders rate, which is another way that people were potentially coping with a higher cost of living and higher housing costs as well. So the multiple job holders rate got to this kind of historic high over the past couple of years at about 6.7% of those employed having multiple jobs. It has eased in recent months, suggesting again that there's less pressure on households to hold multiple jobs, but that could also reflect a little bit of loosening in the labour market as well. And the other thing that households did to really cope with the higher mortgage costs was to reduce the amount of prepayments that they were making. So a prepayment on your mortgage is when you do your principal and interest, but then you also chuck in a little bit of extra income into maybe an offset or redraw account. That's what this chart on the right-hand side is measuring. Again, the prepayment buffers really went up through COVID when we had record low interest rates. Households took advantage of that time to build up the buffers on their mortgage. And it did come lower through the interest rate rises. And again, it's now recovering, suggesting that households are once again in better shape. I talked earlier about the mortgage arrears rate. That had also gone up during the period of cash rate increases between mid-2022 and the end of 2023. And certainly as people rolled off these fixed rates of record low mortgages of 2 to 3% onto average mortgage rates of 5 to 7%, that led to a little bit of an uptick in the portion of mortgage payments that were coming through late. The total arrears rate peaked at about 1.7% in early 2024, and we can see that it's somewhat stabilized since then. So again, this is not a great sign to see that the mortgage arrears rate has lifted, but it is a good sign to see that it's stabilizing. The RBA has also reported on different levels of arrears rates, which tend to be higher if we've got a higher risk borrower. So for example, you can see in this chart, the portion of mortgage payments that are coming in 90 days plus past due are higher among those with less mortgage buffers and a higher loan to valuation ratio, which is pretty intuitive. However, you can see that even in those high-risk categories, the arrears rate has started to move lower into the start of 2025. And we can see the same for low-income borrowers, which is shown in that red line with the arrears rate coming down there too. So no matter which way you look at it, even though arrears have risen, they seem to be more contained now, and households overall seem to be in better shape as inflation comes down and interest rates come down. The other positive and I guess more optimistic chart when we think about the housing market is by considering the portion of mortgaged households that are in negative equity. This is a distribution of the loan to valuation ratio for houses in Australia or for homes in Australia. And we could see through the dotted lines that before the pandemic, there was a fair chunk of households where the mortgage debt was larger than the value of their home. Because home values have shifted 40% higher since the pandemic, that's also shifted a lot more mortgage holders into positive equity. And this has helped to kind of securitize the housing market even further. And the portion of mortgages in a negative equity position is thought to be less than 1% of the housing market at this stage. So overall, I think this points to pretty good outcomes for the housing market from a financial stability perspective, not necessarily from an affordability perspective, obviously. But when we look at the mortgage market, it seems we've got pretty low arrears rates still, which are now stabilizing. And we've got a lot of mortgage holders in positive equity. And again, that's a result of rising values, but also lower interest rates in terms of the mortgage buffers. So why is it the mortgage rates are starting to come down? We're seeing essentially lower levels of inflation. So if we look at the monthly and quarterly CPI, the different measures of monthly CPI, this came down in the year to May. We get the full quarterly result on the 30th of this month. So that will tell us the June quarter CPI results that the RBA was kind of potentially waiting for to make their next cut decision. But overall CPI has been trending lower, and the monthly measure got well within the target band. If you consider the core measure of monthly inflation, which is stripping out volatile items, that was at 2.4% in the year to May. And remember, the RBA is targeting a core inflation level between 2 to 3%. So looking pretty bang on there. Unemployment is rising. So a loosening labour market is another indicator that the economy is kind of cooling down. And so in June, the unemployment rate had shifted higher to 4.3%. It's still low, and I think it's pretty clear that it's structurally lower than before the pandemic. There's been a lot of changes in the labour market, which have just allowed more people to be employed. But the good thing about this relatively low unemployment rate is that it doesn't seem to be re-accelerating inflation. So that means that wages growth isn't kind of spiraling out of control, even though we've got a relatively tight labour market. And that's going to give the RBA more confidence to move the cash rate lower. And the other sign of cooling recently that we saw in the economic data was the March GDP results. That came out early June, and that showed that the Australian economy had slowed sharply in the March quarter. So quarterly growth was just over 0.2%. And 1.3% over the year. And GDP per capita, which you can see in those purple bars, that actually moved lower. So this is another sign that the economy is cooling down, inflation is coming down, demand is coming down. And so the RBA is more justified to move the cash rate lower. And essentially, all of these data reads are telling us that they can't justify holding at 3.85% much longer. Okay, so that's very nice. What does it all mean for the housing market? Well, when you get a lower interest rate, you essentially increase borrowing capacity of buyers. And so usually you would expect to see home values move higher when interest rates come down. So this chart is looking at the official cash rate over time. You've got the axis for the cash rate on the right-hand side there. And you've got the pink bars, which show the monthly change in dwelling values. And since we saw a cash rate reduction in February, we pretty much saw a coinciding increase in home values. After a little bit of a dip at the end of last year, the housing market is back into a bit of a growth cycle again. It's much more subdued than back in 2020, 2021, when the cash rate was 0.1%, and you've got your average monthly growth running at about 1.5% a month across Australia. So it's a much more subdued upswing that we're seeing at the moment, running at about 0.5% a month. So leading more into the capital growth trends, we know that we've got this kind of soft cycle, this increase in home values that's emerging with cash rates reducing. The trend that we're seeing is a real convergence of growth as well. So the markets that have been running really, really hot, like Perth, Brisbane and Adelaide, they're still seeing growth, but the rate of growth that they're seeing is a lot lower now than it was in the previous cycle. Meanwhile, you've got markets like Darwin, Hobart and Melbourne, which were maybe underperforming a bit over the past few years. They've kind of turned a corner now in line with the reduced cash rate. So as a result, we're seeing the range of capital growth reduce. Here we've got the financial year capital growth results for each of the capital cities. And you can see there's a range of about 8.4 percentage points, from the 8% rise in Adelaide over the past year to the 0.4% decline in Melbourne. So that gives us our range in capital growth of 8.4%. But you can see from this chart, which tracks the range in annual capital growth over time, it has come right down from the end of 2024. And that was just as we were starting to see that kind of slowdown in housing market performance. It seems that the range in housing markets tends to rise during periods of upswing. And then when market conditions cool down a bit, that's where they kind of move closer together. So you'll see less difference in 2025 between the top performers and the bottom performers when it comes to the capital city markets. We can see this in the quarterly change in the pace of growth as well. So this is the rolling quarterly growth in home values across the capital cities. And just as I was saying, you can see Perth at the moment, for example, that's got a quarterly growth rate of 2.1%. That's down from a quarterly growth rate of almost 8% this time last year. Meanwhile, markets like Melbourne, which were much more subdued, values were declining, that's actually started to see a bit of an increase and was up 1.1% over the quarter. So that's how we get to that sort of convergence. If we look at the reasons behind that more disparate capital growth, why there was so much outperformance, and why markets are trending more similarly now, there's a few different reasons. So the first is shifts in migration trends. Around the time of the pandemic, you essentially had a lot of people leaving Victoria and New South Wales. There's still a lot of people leaving New South Wales, by the way, more than average. But they were essentially going to states where housing was initially cheaper, lifestyle was better, remote work enabled a lot of these moves as well during the pandemic. And so that led to a real uplift in interstate migration across Queensland, WA, and for a little while, South Australia as well. And so what that meant is that prior to the pandemic, you had a lot of capital cities where the typical median dwelling value was sitting to 400,000 to 500,000. As that interstate migration pressure pushed values higher, that's led to a real kind of concentration in median values across, say, the biggest 5 state capitals. And you can see that in the chart on the right here as well. You've got the median value range across those capitals. It's really shrunk since prior to the pandemic. So if you've got a lot of cities that are sitting at around the same value, they're probably going to start to see a very similar capital growth trend because they're going to have a similar limitation on borrowing capacity and affordability. And I think that's really why we're seeing a slowdown in the pace of growth across areas like Brisbane, Adelaide, and Perth, because their values have almost doubled over the past 5 years. So we've got to start to see a slowdown in capital growth there. Okay, so another capital growth trend that's been interesting to follow is the difference between houses and units. Funnily enough, you might expect units to outperform given that they are a cheaper option for people to buy into. But as interest rates have come down, we've seen that house and unit growth have been fairly similar over the past 3 months. So you can see a real kind of convergence in the pace of growth there as well. Obviously, long-term, houses are going to deliver higher capital growth because of the associated land. You can see that in these charts historically when there's a period of upswing. It's definitely houses that consistently outperform across the capital city markets. And so given that houses are also inherently more expensive, you're going to get higher dollar value return on houses in the long term as well. But units, they may still emerge as a popular option given the affordability constraints for some first home buyers, particularly in some of the larger capital cities where there's a lot more emphasis on infill at the moment in terms of new development. And then other capital growth trends that we follow are looking at the different value segments. So here we've got the rolling quarterly growth of the lower, middle, and high end of our combined capital city markets. You've got house values on the left, unit values on the right. And this is breaking up the markets into those 3 segments. So the high end of the house market across the combined capital cities is denoted in this black line, top 25% of values, and they change over time. Now, usually when interest rates move lower, you would expect the high end of the market to outperform. That's not really happening. We're still seeing a lot more emphasis on the lower end of house values. I haven't looked up the exact value of that lower quartile, but from memory, it'd be somewhere around $600,000 to $700,000 would be where you're 25% and below, or low end of the market, where that cutoff is. So houses around that price point are really outperforming relative to houses that are, $1 million plus. Even though interest rates are moving lower, it seems that there is still a little bit of constraint on that market. And it's the same with the unit sector, actually. We're still seeing the more affordable end of the unit market outperforming the relatively high end. And we'll see this when we look at not just the capital cities, but the regions as well. The good news, though, is that as home values move higher generally, we've seen fewer and fewer suburbs lose value. So this chart is really an interesting way, again, kind of looking at the equity position of housing as well, shows the portion of suburbs over time that have seen a decline in a 3-month period. And the portion of those suburbs which are declining has been coming down with interest rate reductions as well. And we can see that trend reflected across most of the capital city markets. Okay, so another aspect of our market is the regional market versus capital cities. Part of this could be a reflection of migration trends, which remain elevated to regional Australia since the pandemic. But really, we've seen an outperformance of regional Australia, both in the past 12 months and the past quarter, where you can see the combined regionals market is up 1.6%. As the combined capital city market recovers and interest rate moves lower, there is a convergence in growth there as well. But the combined regionals seem to be finding their groove in this kind of slow, steady pace of growth in 2025. We can see this across some of the major regional hotspots as well. So here we've got a few of the popular regional centres in New South Wales. a few in Victoria and the Gold Coast and Sunshine Coast, and they all show a very similar pattern: a massive uplift through the COVID period, a short, sharp period of price falls as interest rates started to rise in 2022, and now settling into this kind of slower, steadier pace of growth in the post-COVID environment. Obviously, that's being aided by lower interest rates. We could see that when interest rates settle, we do get a little bit more price adjustment in these areas just because they are becoming less and less affordable. In fact, if we look at the top performing areas across Australia over the past 12 months, it's definitely more remote regional centres across Queensland, Western Australia and South Australia that are seeing the biggest boost to values. So for example, if you look at a top performing market in the past 12 months, that's Townsville, up 17% in the past 12 months. Part of the reason it's seeing such a big increase is that it's coming off a low base, and the median value there is only about $560,000. Now, that's still a massive increase that will have priced out locals in the past 12 months, in the past few years. And there's other structural factors behind that as well. So they've changed some of the visa settings for Townsville, where there's basically it's easier for overseas migrants to come and work in different sectors across that council area. And you've also got the Army Relocation Program, which has fundamentally boosted demand for housing in the area as well, and is probably contributing to higher prices. But that's an example of where you're seeing the big capital growth across Australia at the moment. I think it's been exhausted in a lot of our major regional centres. I think capital growth is getting a bit exhausted in a few of our capital cities. But it's really those smaller, further afield, cheaper regional markets that are seeing the big growth acceleration at the moment. And then on the flip side, you've got the weaker performance over the past 12 months. A lot of that, perhaps unsurprisingly, is concentrated across Victoria still, where you've still got kind of weak population growth trends. You've got the recent introduction of additional taxes and charges for a lot of investment property owners. And while the market overall across Melbourne is starting to show signs of recovery amid rate reductions, there's definitely pockets of the market that have been held back by those factors over the past 12 months. Okay, so that's the capital growth trends. I'll just go quickly through a couple of other topics that show us a bit more about housing market performance. Part of this is selling conditions. The annual volume of home sales is above 500,000. It's actually higher than where it was this time last year, and it's actually higher than average. But it's clear that over the past few months, there has been a little bit of softness in sales. If we look at the rolling annual the rolling annual volume of home sales across Australia, we can see that home sales have generally been dented during periods of negative economic shocks. So things like credit tightening in the Royal Commission in the 2010s, the onset of the GFC, even the post-lockdown period where we started to see the repeal of government stimulus and rising interest rates. These things have hit sales volumes an average peak to trough of 25% historically. At the moment, we can see that annual home sales look as if they have passed a bit of a peak and are moving lower. If we break that down by cities and regions, so these charts are looking at monthly sales volumes year on year on year, and the different coloured lines are different years laid over the top of each other. You can see that it's really Sydney where home sales are lower than their historic average. And this is also our most expensive capital city. And as we saw in previous charts, it's definitely the high end of the market or the more expensive pockets of the market that are somewhat underperforming. You'll notice Darwin is seeing a really good run right now. So sales volumes higher than historic averages. It's actually got the highest rate of quarterly growth of the capital cities in terms of the value appreciation. So, again, that's one of our more affordable, historically low growth markets that's sort of turned a corner in the current settings. So why is it then that Sydney would be seeing lower sales volumes or more expensive markets would be seeing lower sales volumes? Part of it we put down to just the broader economic environment. And this is reflected in the Consumer Sentiment Index, which I've plotted here in purple on the left-hand side. We've got a consumer sentiment reading that has long been in pessimistic territory. It moved a little bit higher through July, and we do expect it to move higher over the course of the year. But through some of the global economic events that we've seen, for example, Liberation Day in April and the announcement of these Trump tariffs, we saw the Consumer Sentiment Index plummeted 6% in the month of April. Even in the reading for July, we saw that the Consumer Sentiment Index was really weak after the RBA rate decision. So I think there's still a lot of uncertainty for households. And the thing about economic uncertainty is that that seems to affect the higher end of the market more, potentially because buyers at that high end are compensated in accordance with company performance. If you think of executives whose bonus is based on how well the company does that year, or you think of people who own their own businesses and have relatively high incomes, but that income is determined by economic and company performance. So in that sense, we could actually be seeing this low consumer sentiment environment impacting the high end of the market a bit more. And it could also be just putting that dampener on sales more generally that we saw on the rolling annual sales graph, where it's starting to come off a little bit. So does that mean that we'll start to see weakness in housing values if less people are out there buying? The answer is probably not, because supply is also really constrained. We can see this in listings counts. So on the left-hand side here, you've got the number of new listings added to the market on a rolling 4-week basis. The purple line is 2025, and the dotted line is a historic 5-year average. So that purple line you can see is coming in much lower than what we would usually see this time of year. And the same can be said of total listings, where you've got total listings in this real downward kind of trajectory, where stock levels, or every property sitting on the market for sale, is at about 124,000 nationally. And that's almost 20% lower than the historic 5-year average. So stock levels are also very low, and it could be that both buyers and sellers are just not very active in the market right now. Maybe they're waiting to see where economic conditions settle. Maybe they're waiting to see where interest rates settle before getting back into buying and selling. And this is a pretty common trend. If we look at total listings across each of the capital cities, we can see that total stock levels are lower than their historic averages in each city. Hobart's really interesting, right? Hobart, as we know, had a relatively large correction as interest rates rose in 2022. And the market had been stagnating for a while. Now we're seeing stock levels being very tightly adjusted. We've a big rapid decline in the level of stock across Hobart, and you've got a more positive growth trend there. So that could really be a reflection of an improving market across Hobart. Other indications like typical times to sell, so median days on market, that's sitting at 32 days across the combined capitals. And that's up from 25 days at the same time last year. So it's taking a little bit longer to sell property than it was this time last year. And vendor discounting is also tightening up a little bit. So we're seeing not as dramatic a discount offered on homes sold. If we look at the clearance rate, so that's trended a little bit higher over the past few weeks. And again, that's probably in line with things like rising values, lower interest rates. However, there might be a limit to how long that momentum can last after we're through the rate cutting cycle. And historically, when we look at the clearance rate after periods of rate cutting, it does tend to have a little bit of an initial boost and then settle down. Now, the interesting thing about the auction clearance rate, and the reason it's useful to follow that, is that it's very tightly correlated with the direction in home values. A higher clearance rate across the capital cities indicates higher demand, indicates higher prices. So you can see that correlation here on the right-hand side between the clearance rate in the purple line and the monthly change in dwelling values, which is the black line. Some other interesting insights that we've seen from data flows in the past few weeks is the ABS home lending series or housing finance series. And the interesting thing about this data is that they cut the number of loans secured for residential property purchases by buyer type. And from that, we can derive different trends in who is purchasing property nationally and by the states as well. So here you can see the share of home loans secured for property purchases in terms of the subsequent buyer. A subsequent buyer is a buyer who, it's not their first home purchase, but they are an owner-occupier. So they might be upsizing, downsizing, moving around. Now, the trend nationally has shown that this subsequent buyer, they make up the highest share of purchases from this loan data. But there's been a distinct decline in the share of them over time. Even though they're still the dominant share, that share is declining. And in their stead, we've seen more interest from investors in recent years. That's coming off a relative low from the onset of the pandemic, where investors were quite spooked at that time, and we'd just been through the Royal Commission into financial services. So that investor picture had generally been recovering. It's faltered a little bit in recent months. And then we've got the first home buyer share, which has been fairly steady over the past few years, currently sitting at 22% nationally. But it is lower than when we saw policies like the introduction of the home loan deposit scheme and home builder, which was also very popular with first home buyers. So the first home buyer share is somewhat steady. We think that the first home buyer share will probably increase in 2026, partly because you've just got the expansion of the first home loan deposit scheme. So currently it's limited to, I think it's about 30,000 places a year for first home buyers, and the low deposit schemes go up to 50,000 places a year. And currently it's limited by income. From 2026, it's going to be an unlimited scheme in terms of what income you're earning. As long as you're a first home buyer, you can get access to the scheme, and the number of places will be unlimited. But the only thing that it will be limited by is the actual property price. There will be price caps on the scheme. So that share could tick up a little bit in 2026, and that'll be something to look out for, especially where you've got lower interest rates, which will make mortgage payments more feasible against rental payments. And so that's probably a good place to hit on our last topic, the rental market. So the rental market remains pretty tight in terms of supply. We've seen a trend of slowing growth in rent values. Unfortunately, there are some markets where rents are re-accelerating, which might make it a bit more challenging for renters. But overall, there's been a gradual slowdown in the pace of rent growth. So these are the vacancy rates that we're seeing across Australia. You've got vacancy rates of less than 2% generally, and that compares to historic averages of about 2.8%. You can see that each capital city and regional market of Australia has a rental vacancy rate that is below a historic 10-year average. This makes sense. When you think about the 2010s, it was characterised by a lot of unit development, a lot of off-the-plan development. And so that really sort of flooded the rental stock with ample supply, and rents didn't really move very much during the 2010s at all. It was really through COVID where you had a bit of a disruption to investor activity, and you had these big changes in population, income, and household formation that really tightened up the rental markets and have led again to this real structural shift in the level of vacancy and the level of rental supply across Australia. Despite that, it appears the worst of the rental boom may be over. Here we've got annual growth in rent values across houses in the purple line and units in the pink line. And you can see that for annual growth in house rents, they've generally been moving. How do we see 2025 shaping up? There's still some challenges in terms of the volume of sales and how far prices can go. Housing is still really unaffordable for a lot of people and sits well beyond even where their borrowing capacity is at lower interest rates. There are concerns around household debt as well. Just because interest rates are coming down, we're still going to see an emphasis on pretty conservative mortgage lending in order to make sure that people can keep repaying their mortgages and we don't get a blowout in arrears over time. As you saw on the previous slide, we've also got net overseas migration slowing down. It's normalizing since the borders were reopened in 2022. And that means that you've got less pressure on demand for housing as well. And then we've got the global uncertainty. I mean, I think we're in a bit of a new normal when it comes to geopolitical risk, economic risk. And so that could put buyers off as well and certainly weigh on sentiment. I imagine there will be a point where we kind of get used to the chaos, and that will lead to consumer sentiment improving. So that leads us into the tailwinds. We've definitely got a tailwind for the market in the form of lower interest rates. Lower interest rates means more borrowing capacity. It means higher prices and more people looking to buy. We've got improvements in economic and household conditions, despite the fact that unemployment is up, GDP growth is low. The flip side of that is lower inflation. As I said, sentiment is expected to rise, which will support transaction volumes and tight supply. I mean, both from a building perspective and a listings perspective, the lack of stock coming to market helps to support home values and put a floor under home values. So overall, there are some downside risks that remain for transactions in the housing market and for prices. But for 2025, we think ultimately it will be supported by lower rates. And some of the economic uncertainties that we saw at the start of the year, we're getting further and further from those events, and the risks seem to be dissipating a bit as well. Noting that there might still be, prudential lending and focus on household debt. Overall, we think that we'll have another positive year of growth for the housing market in 2025. So I will leave it there. We've got my contact details in the deck along with Casey's. If you need to get in touch about any of the data or information that you've seen today, happy for everyone to have a copy of the deck and feel free to reach out anytime. And thanks for your time and attention this morning.
Thank you, Eliza. And we'll send through that later today to everybody. Thanks. Have a great day, everyone.